Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. So last year we had a significant volatility, especially around tariffs the first half of the year. But oh yes, we also had a really strong rally and the market was up 18%. But when you looked at the pessimism that surrounded the market, pretty historic amounts of bearishness. And if you look back at history, that could set us up for a strong 26. Now, emerging markets, debt and equity had a really strong year in 25. Let's talk about when we look at interest rates versus inflation, why emerging markets countries could have a lot more room to cut than many developed countries. And then finally, earnings, big driver of returns in 25. Taking a look at consensus estimates, it could be another major driver of returns in 26. Now, the American Association of Individual Investors poll, the AAII, asks their members every week, are you bullish, bearish, or neutral on the stock market over the next 6 months? And we went back since the inception of 87 and calculated the average annual bearish readings for each respective calendar year. And as you see on the screen in 2025, the average bearish reading was 43%. That has only happened with that reading above 40% 4 times in history. So the amount of pessimism surrounding the market that was up 18% was quite fascinating to observe. Now, looking at 1990, the first time that occurred was the Gulf War savings and loan crisis. We had significant drawdowns, market slightly finished negative, but a lot of volatility and concern during that year. You had the great financial crisis, '07 to '09. '08 and '09 were years in which that bearish reading was above 40%. If you remember, in '09 had a nice rebound from March, but it was down more than 20% in the first 3 months of the year. And then in 22, we had inflation at its highest reading since the 70s, interest rates moving significantly higher by the Fed. We had that last bear market, bearish reading up at 46%. So always happening during these really volatile times, but take a look at the forward 1 year returns after you reach these bearish extremes. The average return in the other four examples in history was 25%. So does that mean we're going to get a 25% return in 26? Probably not. But we've had 3 consecutive years of 15% gains. The amount of pessimism that we experienced in 25, it could set us up for a nice 26 as this pessimism is unwound. We've already started to see that during the first couple of weeks of January. Now, emerging markets have a lot of room to cut rates. At the top of these two tables, the first table up top, you see developed markets, US at 3.75% upper bound Fed funds rate is 1.05% above its inflation rate. So yes, you hear that inflation is not down to the Fed's target of 2%. That is absolutely true. But the Fed still has room to potentially cut rates up to 100 basis points before they're actually even in restrictive territory. Now, the euro area is not in the same circumstances as the US. You see rates and inflation are virtually the same. They don't have a lot of room. Japan is actually increasing interest rates. Now, as you go to the next table below that, you can see the story unfolds completely because a lot of the emerging markets countries, those differences between rates and inflation are significant. All of them are higher than all of the developed countries. So a lot of these EM countries have a lot more room to cut interest rates in 26 than developed countries. That could be a tailwind, especially for EM debt and somewhat EM equity. EM equity perhaps was priced in a little bit this year, but I think that could be a tailwind for both asset classes this year. Now, in 2025, we've talked about it in the past. Earnings were a major driver. If you look at the chart here in the orange, those are the total returns for the S&P 500 stock market each of the last 4 years. We had the bear market back in 22 that we just talked about, and then we had those 3 strong years. Now, the chart also shows earnings in teal and valuations in blue, and then in the green is the remaining dividends. And when you take a look at 25, you can see 14% of the 18% were driven by earnings. 26 consensus estimates for earnings growth from S&P 500 companies is 11%. You tack on another 1% expectation of dividends, you're right there at 12%. That's another nice year. Now, does that mean the market's going to experience exactly 12%? Almost certainly not. But even if we get somewhat of a contraction in valuations, I think the fact that earnings are expected to be so strong and were a major driver last year, that is supportive of an equity market and potentially a cushion for any labor market weakness that we experience. Now, a lot of talk about ChatGPT and robots and Mars and automations and all these things. But handwriting, right? Pinterest put out their 2026 trend report that showed a sharp increase in searches related to handwriting. They had cute stamps plus 105%. That wasn't me, but somebody else did. Pen pal ideas was up 90%. And handwritten letters, the searches were up 45%. So this younger generation is interested in writing letters again, that handwritten touch. I don't know if this is a backlash to sort of the automation and ChatGPT AI revolution, but it will be interesting to see if the handwritten letter makes a comeback because I'm going to have to work on my handwriting if so. With that, I want to thank everyone for watching, and I'll see you next